Hello, everybody. It's Thursday evening. You're here on the Smart Connector group with us, unless you're also watching the replay on YouTube or listening on the podcast. And I'm here tonight with a wonderful guest, Arshad Ali. Welcome, Arshad.
Thanks, Jane. Hi, everybody.
Now, I was saying beforehand that, Arshad, you're actually looking a bit knackered tonight. For our viewers or listeners in other countries, knackered is kind of an English word which means kind of a bit worn out. So, Arshad, what's going on with you apart from me flogging you half to death over the last week?
I was about to say you're the chief inflictor of the tiredness, but I'm a new father, so I've got a little 4 weeks.
Oh,
Ali. So, and I've also got a 5-year-old who's just started primary school. So you can imagine trying to find a balance in between that and also, deal with your demands as well. It's that explains the panda eye.
Okay, so I suppose we ought to talk about what my demands have actually consisted of. Arshad and I, we hosted a masterclass this week. It was an investment raising masterclass, and at it we launched the 90-day accelerator to help you get your ideal investor within 90 days, which is an entirely achievable target. So tonight we're going to be talking a bit about finance raising, and we're going to be also talking about your own personal journey, Arshad, and because you're still actually active in corporate life, aren't you? You have a job, don't you?
Yeah, I love my job. It's I work as an actuary for Scottish Widows Lloyds Banking Group. So this is where I send everyone to sleep. I know it's late if you hang in there. The joke is accountants find actuaries boring. So there you go. So it's to do with financial modelling, risk analysis, investments, pensions, insurance, and businesses. So it's to find the weaknesses and to mitigate them or to quantify them before they become an issue, or how much investment you need in order to take that risk away. Because sometimes you have to just take certain risks and the money involved to cover it or to mitigate it is too expensive. So you have to make a decision on it. I'm the person that kind of helps you find that. But also we also do the underlying risk in big pension funds and also insurances. So we don't really decide the premiums, but we decide whether it's a profitable product as well. So it's all that sort of sexy stuff in spreadsheets.
Well, indeed, and I'm not like a massive spreadsheet geek myself, so I just love working with people who are very, very, very geeky in that respect. So there's clear parallels, obviously, between your property investment and what you do in your corporate life, Arshad, because investment is really all about calculating and managing risk, isn't it? I mean, that's a fundamental bottom line principle, isn't it?
Yeah, 100%. I mean, one of the things that I think the appreciation of risk is sometimes a little bit skewed. I'll give you like a brief example, but one of the biggest risks a lot of people don't factor in is the risk of doing nothing. A lot of times the fear of taking action, the fear of going down this path or that path is too great that they stick on the path that they're in because it's the path of least resistance. However, what they don't realize is what they're losing is that opportunity cost of where their life could go. Now, that's not a lecture, so that's just what I firmly believe in. That's one of the important things that you have to do when you're understanding a process is, if I invest in A, what else am I missing out in? And that's the same principle I kind of apply to in life as well.
Indeed. And I come from a very risk-averse family. I mean, my father never invested anything. And everybody in my family thinks that I am just insane. They really do, because they're like, but, it's risk. If you do any kind of investment, there's risk. And that is just their mindset. And that's a mindset of a lot of people. And it's a great shame, because they are missing out on opportunity, aren't they, Arshad?
Yeah, it's totally understandable though, because society by and large wants to know what you're going to do because then it can deal with it.
Mm-hmm.
So if you start doing things where it starts propelling you or taking you to massive lumps or jumps or leaps in your life, people don't really know what to do with it because your social circle will change. If you start and then you progress, you find that some people stick with you, some people don't because you're an alien to them. So going back to sort of the element of risk, it's understandable why people don't take risks, but investors take that risk because the risk that they're taking is they're leaving the money in the bank account.
Mm-hmm.
Yes, you've got the guarantees from the FCA for 85,000 of your personal money, but 0.1% base rate at the moment. You for 85,000, you're looking at £8.50 or £85 in a year. So that's the kind of risks that people need to kind of understand that's happening in their day-to-day life.
And I mean, certainly, obviously, inflation is quite low at the moment because of COVID-19 and the general state of the economy. But most of the time, you would actually be losing money by leaving it in the bank, wouldn't you? And of course, people have to realize that the value of their capital is eroding if they don't invest.
Yeah, that's one of the fundamentals of why I got into property investing, because essentially it's effective of using inflation in a way that's advantageous to me. So I'll try and purchase assets which I hope to grow, although I don't bank on them growing. I hope them to grow. So you take on debt, which with inflation actually reduces. So for instance, I just explained to the viewers how inflation works. You buy something for £1 today, in a year's time, it's going to cost you £1.05. So that's your buying power reduces with inflation, but also debt reduces with inflation as well. Does that make sense?
It is with inflation. So, no, sorry, you've lost me.
So take an example, and it's important that if viewers have questions, if they drop them in, because say for instance, 10, 20 years ago, right, you bought a property. Can you give me an example of that? Say you paid 100 grand for it 20 years ago, and say you borrowed £75,000 for that property. Now, fast forward to now, what can you buy with 75,000 compared to what you could buy with 75,000 back then? You see, You see how now you're better off having put that money in that property because they'll have had a chance to grow, and you still owe that same 75,000 or maybe reduced over time. And that's really the magic of using debt and the power of inflation to combine. I know this is meant to be a light-hearted chat, so I'll reel it back a bit.
It's okay. I knew that we were going to get geeky at some point, so that's cool. Now, I obviously also work in investment, so that's my other business that not everybody on the group necessarily knows about. But I first encountered investors when I was running my design agency in London. And the owner of the agency, I was an MD and shareholder, so I was a significant shareholder. But it was really his business. And he said, I want to scale up through investment. So that was his first goal. So, I mean, obviously there's investment in property, but there's also investment in business. So we actually lined up 3 angel investors, and they were going to take a 20% stake in the company. And we had all of the business plans. It was for about 300,000, 100,000 each. And we had all the business planning all done, and they were all set to go. And then the growth kind of took off when I say by itself, I mean, obviously, that was also my responsibility. So I did have quite a lot to do with it. But we started growing very fast organically. And then he just got excited about the thought of a sale. And, it proved to be the right decision because we actually made a lot more money than we would have, I think, if we'd gone down the angel investment route. So now what I do is I raise funds for development projects, or I match investors, because I don't just work in development. I match investors with opportunities that are right for them. So I'm kind of working at a different end of the market to Arshad. But I think it's very, very important. I mean, this is the reason why we teamed up, because my experience of investment is different. It's generally tends to be more, should we say, professional investors, high net worth, sophisticated. Well, you also deal with high net worth and sophisticated, with that very specific, classification. But I would deal with people with probably a lot more money, or institutional investors or their representatives,
I don't really deal with the institutional.
No.
It's one of those ones where what I need, because I'm very particular and careful about matching money, projects, and the investor profile with me.
Yeah. Mm-hmm.
And it's something that you can look at further down the line. But for me right now, I don't need that institutional investor.
Well, exactly. As I said, it's all kind of, it all sort of goes on a spectrum, doesn't it? So,
Yes.
a lot of people, I actually mentor people who are starting off in property and they've got some money, they want to build a portfolio. I don't do all of that silly no money down stuff. I just disapprove of all of that. So I'll work with people who they might have a couple of 100,000 or something that they want to know, how shall I get started? So I'll work with people like that. But those kind of people, of course, the first thing that they want to do most of the time is actually build a little portfolio, and they want to know what's the best way to do it. So many of our listeners or our viewers or whatever are going to be in that situation where they're maybe early in their journey and they're thinking, is property the right vehicle for me? Is it, should I do property? Should I invest in another asset class? Should I actually build my own portfolio, or should I just not have anything to do with that because I don't want tenants, I don't want the responsibility, I would rather just get the return and just make sure that this appropriate security is in place, and then I can, if you like, leverage the activity of people like Arshad, or some of the other people that I work with, and actually just get a return on their money, or in some instances, and of course this happens a lot in development, actually joint ventures, so that they are, if you like, a silent partner. So you've done quite a lot of this, Arshad. So I'd love to talk about how you actually started on your journey, because we're saying to investors, well, to entrepreneurs, we're going to help you get your ideal investor within 90 days. We believe it's possible, but I think what would be interesting is for them to hear, how did you get your first investor, and what's the story?
Well, with regards to, I'll give you a quick background as to why I got into property, then I'll go into the difficulty of the first investor. So back in 2016, I broke my back. It was an accident. So for about 9 months, I couldn't stand, walk, sleep, eat, etc. We had a couple of restructures at work, although I was pretty sure my job was safe. But whenever you have a restructure, you never truly know until you come out the other end. I didn't quite like that lack of control, that risk. And I wanted to kind of take it in-house, and I had a look around and researched, because that's just what I do, and I thought property was the asset class for me to kind of focus in on. So that's why I got into property. Now, with regards to getting my first investor, it was actually very organic, but looking back now, I can see there was actually a process happening that I did. When you're doing something for the first time, you don't know what it is, because you don't know where you're starting from or where you're ending. But essentially, as you see, I'm very active on social media. I've got the background as an actuary, so I've got that kind of credibility automatically building up, because you don't become an actuary, or you don't get into the actuary field without the commitment of study, degree, exams. So it's that building that personal brand. But I was naturally displaying it in social media, but also talking to my friends, the kind of organic way. Now, the thing was, I wasn't actively asking for investment, but I was just sharing what I was doing. And because of the consistency of my message, because of what I said, how I said it, when I said it, and to the right people. They actually wanted to come invest in me because not only did they want to invest in me for the returns, but they wanted to invest in me as a person to help me grow as well. So there's that kind of synergy going on. Your friends and family want to help you.
Well, I mean, the thing is, some friends and family will want to help you. My family didn't want to help me. I mean, they were like, as I said, they thought I was completely insane, and they were like, "There's absolutely no way that we want to help you. We're not risking our money." So, I mean, it doesn't always happen that way. And sometimes friends as well. They're like, "Well, yeah, I like the idea of property, but I'm going to buy my own property. I don't want to lend you any money or do anything like that." So it doesn't always come from that source. Obviously, it's a help if it does. But I think I've heard a lot of people say friends and family first. And if you have that route and that kind of access, that's great. But I wouldn't want anybody to think that it's not possible because you don't have friends and family. What is important, I think, is that people, as Arshad said, investors will want to invest in you as a person. And the first thing that they're going to want to know or want to satisfy themselves about is, do you know what you're talking about?
Yeah. So just taking that point, so one of the sort of main attractions about what I do and the synergy, because at first I didn't understand the connection between property and what I do, but over time I've realized I understand at a sort of deep level the risks involved in property because my day job is about identifying mitigating risks.
Yes.
So for instance, with my investors, I've made arrangements that they will still get their money whether, if, for instance, God forbid, something happens to me, I pass away, or even if I'm in permanent incapacity. So they know that that's something that wouldn't even cross their mind. And I've kind of taken that into consideration. That gives them that peace of mind. Then you've also got you have to show how will you return this money. And if you things like, next of kin documents, and that tells the people that, well, clearly this person is a business person that wants to transact, because as we said earlier on, investors have to invest, otherwise their money erodes.
Mm-hmm. Yes, indeed. And that thing about the point that you made about risk, it is so important, about understanding risk, and also about business, because you can't fake business experience, not really. People who are experienced in business, and a lot of the time sophisticated investors who are the kind of people that will perhaps lend you money and help you build your business, or angel investors as well. They're usually very, very savvy, smart people who have a lot of business experience themselves. And, if they think that you are somebody who you don't really know what you're doing and you don't really have that experience, then they won't be very warm about the prospect of investing.
Yeah, because the reason why they're able to invest is because they got someone to invest in them, or they've worked hard in order to be able to raise that investment. So they understand how it works. They're just one step ahead of you, because when you make money, you will then become an investor yourself, and you'll understand why it makes perfect sense for someone to invest right now. The other thing with investors, especially in business, they not only are investing in you, but they're investing in the team around you, because that's representative of who you are and the people that you keep in and around you. If they don't resonate with the investor, then this relationship isn't going to work, because if they see that, for instance, your supplier or your digital marketing company, they just don't click or don't understand, then if one piece isn't right, then they can walk away because they've got the money, it's their rules. But that doesn't mean that all money is good money, though. And that's something that we kind of discussed on Monday, Jane, isn't it?
It is indeed. Investment is first and foremost, it's about people. And that goes right across the board, whether you're a VC or a private equity investor, or whether you're just, somebody who's lending £10,000 to a friend or a relative. It is really all about people by people, and you've got to have a high level of trust if money's involved. And you shouldn't trust blindly. You really need to know where that security is, and part of that security lies in the people that you're choosing, because that is the thing that you can't always do your due diligence on. To a certain extent, you do have to rely on intuition and your gut instinct, really.
So just talking about the gut instinct and intuition, there's ways of, as someone that's trying to raise investment, you can help influence that. And the way to do that is to put your best foot forward and have that consistent message across all digital platforms. So that way their gut, if all the other boxes are ticked, then it's just about the return. But before you even get to the return on investment, which is the interest rate, you've got to tick all these other boxes as well as return of investment. And that's what the risk part is. If they don't think they're going to get their money back, it's different with venture capital firms where they have the Pareto Principle. But if somebody doesn't think they're going to get their money back, or there's something off, you won't even get a chance to discuss what the return is.
Indeed. And you just touched on something there that we raised in the masterclass about, VCs, for example, that are investing in tech companies, for example, and the Pareto Principle, which, we kind of skimmed over it, but people might not have heard of that, or might not know that the Pareto Principle is the 80-20 rule, which it cuts across the board in so many different areas in business. And the Pareto Principle is basically what it is that 20% of whatever it is that you do provides 80% of the results. So in investment, then I think Arshad's back. Hello, Arshad. Okay. So with investment and with tech investment, for example, then I think he's there. He is again. Okay. So just saying that with tech investment, for example, then tech investors know that probably 80% of the investments that they make will somehow not really work out very well, and 20% of them will skyrocket. So it's very, very different, isn't it, in property, where really people, it's low risk and people expect to get their capital returned, plus a lower percentage of profit.
Yeah, so it's one of those ones that you've got that sort of constant, well, not battle, but it's that conversation when people are talking about win-win. What they mean is, because obviously in game theory, the investor wants to get as high a return and as much security as they possibly can, whereas the person looking for investment is trying to give away as less as they can. So it's finding that balance, and that's why you go to the right people and you've got the right message, and there's that consistency. I think I'm having some more technical issues. Sorry about this.
Well, I can still see you, Arshad. So it seems to be.
Can you hear me? Can you hear me? Okay.
I can hear you. Okay. Yes. So.
Brilliant.
Just when it drops out, but it seems to be fine right now.
Brilliant.
So let's just talk about the purpose of investment and the impact that it has on entrepreneurs, and why entrepreneurs seek it. And as I said, this is across the board, not just in property. So Arshad, what was the attraction of investment for you when you started your property portfolio?
Well, your money runs out. Just your money is limited. There's only so. I mean, one of the things that I'm grateful for and thankful for is almost the aspect of not having a huge pot, because then it forced me down the path of investment, because otherwise, after the first property, I'd be stuck. And I think that's what a lot of people in the property world, what happens is they've got enough to get one, and then that's it. But what this raising, so over the last 2.5 years, I've raised around about £300,000. That's all not new money, but that's because I've managed the relationship correctly, because it's a lot easier if you manage the relationship correctly to get reinvestment than it is to try and get a new investor all the time. And also means that there's something possibly wrong with your setup or how you're doing it, unless it's a specific unique characteristic. There's only one project that your investors should be reinvesting with you because you've done all the hard work and those things that we talk about in the 90-day accelerator. Now, what that's allowed me to do is build a portfolio with $500,000 that brings in £35,000 gross a year. I don't say that to show off. I'm sure there's people with a lot more, but I mean, that's more than the average salary, the UK salary, as not my side thing, but you understand, on top of my wage. So now if anything happens to me, if I have any sort of medical mishap, or if I need time with my family, then I've got that flexibility and freedom. I know some people want to travel the world. Well, technically I could if I was a bit more frugal. That's what investment allows you to do. It gives you the freedom to live the lifestyle that you wish to have, but you've still got to work hard. You've got to sweat it. It's sweat equity, isn't it, ultimately?
It is, absolutely. Now we've got a question coming through. So just hold on a sec, Arshad. It says, what would be your top tip to find your ideal investor?
I think to find your ideal investor, the thing is, for me, you have to get your messaging right.
Mm-hmm.
Because you could look everywhere, but if you don't project the right sort of attributes, then it doesn't matter where you look. You will never find the investor, your ideal investor. For me, for example, is you can look at the consistency in what you do and everything that you do, and how you do anything is how you do everything. That I kind of ascribe to that, and you've probably seen that in how we work over the last while that we have been working together. That there's a consistency. You know what to expect from me, and you know when to expect it, and you know it gets delivered irrespective of what's going on. And it's those kind of messages that we kind of drum into people along the way. That's how you find your ideal investor, is what you project, because there are other mechanisms that you can use, the algorithms that you can use to then find the ideal ones that match what you bring forward and your values as well, which is very important.
Indeed. And the reason why we talked about the ideal investor, which is a question that Dan's asking, is I know people who have built multi-million-pound businesses with just one investor, one financial backer. It is infinitely possible. Now, people do it in different ways, because I'm not saying there's never, ever, ever one size fits all. But as I said, I know extremely successful developer who works with, he has two people that he works with. One of them was his accountant. That's how he started out. And when he saw the kind of money that he was making in one of his development projects, he said, well, actually, you know what, I'd quite like to get involved in this, but I don't want to do the work. And that's how it all started. And, he's stuck with this guy for 30 years. So it honestly is a bit like a good marriage, that you really only need one.
Yeah, it's that partnership, isn't it? It's if you get the right partnership from the beginning. And with the accountant, there's that level of like, know, and trust already, and that's that's a fundamental to any partnership and marriage. You don't just jump in with anybody, because there's plenty of money out there, and if the investor that you get on board because you're desperate or you really, really need it, you just take anybody on, you'll actually end up might not liking doing the project or the investment or the business that you're doing, because you've got someone hounding you, or they don't understand it, or they don't get it. So that's why one of the key things that we kind of keep on going about is the messaging and getting it right, so that way it's your ideal investor rather than just any investor, which wouldn't help propel your growth in your business, because they need to be invested in you in the sense that they want you to do well, because then you can then return, and in return do well for them.
That's right. That's right. So, I mean, I've been doing this for a few years now, Arshad. So, I'm going to pass on some learnings at this point, if that's okay with you.
Of course.
So, I think it's also very much about setting expectations, and I think that I think of one particular investor. I actually introduced this investor. I don't really do this anymore. I don't sit in the middle of the sandwich, if you know what I mean. I just don't do that now because it's not a particularly nice place to be. If I introduce an investor, then I will also get involved in the deal and make sure that I am active in it and that I see it all the way through. So in a way, I become a partner. But this particular instance, I introduced an investor to another developer, and the developer didn't really give the investor the right information in terms of setting their expectations. So they thought that, and they had planned for their capital to be returned within 18 months. And in actual fact, the project went on about 9 months longer. Now, this is very, very common in development.
It always does. You know, a lot of people in their head, it's that contingency aspect, and managing expectations is what that risk, contingency, understanding all those components, you know, as you're saying.
Indeed. So what actually happened is they should have said, look, the best case scenario, your money will be out within 18 months. Worst case, it could be 3 years. But a lot of developers, they won't say that because they know that investors, like 3 years makes them very uncomfortable, and they would rather think, okay, in terms of a year or 18 months makes them feel more comfortable. So I've seen effectively developers kind of play a bit of a smoke and mirrors game. And then, of course, that really upsets the investors because they have planned for their funds to be returned at that point, and they have got plans for those funds. And so I would say that if you are working on the property side, if you are the active partner and you're working with investors, always think about the worst case scenario from their point of view, which means what happens if the project runs into difficulties? What happens if there is a project overrun? What happens if there is a house price crash? You know, what if? And think about the worst things that can happen, and then answer all of those things truthfully and upfront right from the start. Because otherwise, if you're you know, well, it's just a recipe for unhappiness all round. So I would like to say that.
Yeah, no, that's a top tip there, because fundamentally it's that thing we were talking about the partnership. It's communication, you know, because there's ways of saying it and there's a timing of saying it. Because if that's what you come out with, they're like, well, this person isn't really looking to, you know, if he's hitting me with all the negative. But as you say, it's getting that messaging right, but having honesty in what you say, but picking the moments to kind of translate that message towards them. Now, I can see there's a question in there about how much security you can offer should determine the return you can pay. Now, if it's all right, if I take that question, Jay? Yeah. So for me, that is a component. Return and security they are interlinked, but that's not the full story, because I invest myself as well as raise investment. Now, for me, it's not everything. The security doesn't determine what I want, because that's where the message and the trust, because there's certain people that I don't need the same return from, or the same security for the same return, because I know, trust, and like them already. Whereas if someone new, then it's that Pareto Principle again, where you know, and it's the same that credit, all finances houses apply that as well. Like my bridging company, they offered me a certain rate on my first bridge, but by the time I got to the third and fourth, they didn't want the same sort of skin off of me, you know, because they go, well, this guy, he regularly and he delivers, we want to keep him in business, and the projects he picks are good, you know. So just to kind of answer, I don't have the name, but you can see the question down there. What's your thoughts on security and return, Jane?
Development is a very high risk, a high risk sector, should we say, compared to what you do.
Yeah.
So the risk is very, very, very important. And I personally, from my personal experience, I don't believe that you should ever sell a deal to an investor and try and get them excited about it. I really don't believe that that is the right approach. I think when you're dealing with, larger projects, I think safety, actually the investors really understanding what are the contingency plans, what are the outcomes, what are the different scenarios, what are the different exit strategies, and how is that going to affect my money, both in terms of it's not just the ROI, it's the return on the annualized return, and all of those different kind of minutiae that are very important. And how am I protected? And what I have seen a lot is investors, they don't want to take any risk and they want very high returns. So they basically want you to put in an asset to protect their funds. So like you put your house on the line, put whatever it is that you've got, so that in the event of things going wrong, they can just, pull the plug, just like a bridger. But they also want, the really, really high returns. And I think there's plenty of very greedy investors in the world, and that's fine, there just are. But it's important to know, when we talk about ideal investor, an ideal investor is somebody who is like a project partner. You're going to beat them halfway, because you're going to be explaining to them, look, this is what this project entails. And the very best investors will want you to win as well as them. They're not out to exploit you.
Yeah, you raised two great points there. The first one was, so people can be sophisticated investors in a certain field. That doesn't mean that they understand the investment that you're asking them to invest in.
True.
So therefore, you have a duty of care with regards to that money, because technically you are the more sophisticated person, because it's your deal, you understand it better.
Yeah.
So, that's a fantastic point that you raised there. The other is, there's, if the investor wants too much, well, you shouldn't, they're not your ideal investor. But you also need to make sure, are you giving away enough to attract that? So there's a skill, and it's what I was touching on earlier. I wasn't sure if I was transmitting, but it's that creating that win-win scenario, because we've got at first it would seem you've got two conflicting points of view. You've got the investor who wants as much as he can get, and you've got the person raising the money wanting to give as little as they can. How you get them together is if they're both focused on the success of the project or the business, then they both win. That's really the key.
Indeed. I totally agree with that. And, as I said, particularly with development, because development is complex, very complex. It's not a game for amateurs, So there are so many different variables, and a lot of them are actually outside a developer's control. Because, for example, everybody knows that the economy is going to have a massive impact on the outcome of, say, a large development project. I mean, it's inevitable, isn't it?
Yeah, I mean, just to touch on that with regards to sort of COVID-19 where we are. Now, we are technically in recession. However, house sales are through the roof. Now, what that tells me is that is just pent-up demand. That's people that have been stuck home for the last 6 months, looking at the same four walls, going, I don't care about my financial prudence. I don't care. I just want out of here for my mental health. And and the other aspect is totally understandable, is that, well, people just now are not really concerned about 2, 3 years or 4 years down the line, because it's that our mortality has been brought in front of our eyes with regards to what's happening. So people are going to be making a lot more short-term decisions. So that's why the market is so hot. But we are in recession, so that means that there's got to be checks and balances along the way. And one of the ways to kind of compensate the sort of predicted drop, around about 10 to 20% in the housing market, is to be keener with your purchase, or to be keener when you go into the deal at the beginning, so that you factor this in.
Indeed. And of course, the other thing is that the government has artificially stimulated the housing market right now because of the stamp duty. And that's particularly prevalent in the area that I live in, because, it's an expensive area. And so it's amazing the number of for sale signs that have just sprung up as a result of that, because all of the homeowners, they all think, wow, this is great. This is the time to cash in and, get that really maximum value that we can. Whereas where you live, Arshad, is obviously prices are not going to be as affected by that.
Yeah, well, actually, prices up here are through the roof, are on fire as well.
Really?
Yeah. So on a daily basis, like the properties that are selling that are within a day, the sign goes up. Literally 2 doors down from where I stay, sign went up within a couple of days. It had a sold sign, so it is on fire everywhere. And I think it's more to do with the pent-up demand and the mindset, rather than the sort of the financial prudence. But just going back onto the point about people selling at the peak, if it's their home, if you play the logic out, then they will then be paying more for where they move into. So unless they plan to sell and hold on or rent somewhere, they're actually buying into the heated bubble themselves. So they're not making what they think that they're making. Do you get it?
Well, I mean, the thing is, they're not smart investors, savvy investors, are they? So they're just the masses. They're a bit different, aren't they?
Yes, exactly. And these are the key kind of understandings that you need to have about the industry that you work in and the businesses that you run, so that way then people can see that you've got that vision ahead, that you can see what's going to happen. So that, hence the reason why you can find your ideal investor, because you project the correct message, but also the ideal investors come and find you because they'd rather someone, as you said, about the development, understood that it's going to take more than 18 months and have the contingencies in place, than someone that's not, that might be offering that higher return or even a little bit more security.
Yeah, I mean, I've got an interesting confession to make, which is that in the early days, I thought I had to go out and look for investors. So I did a little bit of business networking, and I didn't really find any investors. And then I thought, then I stopped looking. And at that point, I just stopped looking, and I just did what I usually do. So I went to the gym, I took the dogs out for a walk, and I did my usual stuff on social media. I'm quite active on social media. I am approached constantly by investors. I have some amazing people that approach me. I mean, really, really, really smart people, and they just find me. Like literally, they find me. And now,
so sorry, can I stop you a second, Jane? Right.
Yeah.
So let me just frame that for you, your shock and awe that they find you. So we're live right now, 8 o'clock on a Thursday, which you are every evening. You have the Smart Connector Group. You sold a company for 5 million. So can you see why they might accidentally find you? It's your messaging, it's your positioning. That's why they come to you, and that's I think that's the point that you're kind of going on to, isn't it?
Well, it is, and that's why. We weren't going to talk too much detail about the pillars of the program, but part of it is definitely, when we say create, that is the central part, that you have to have a digital footprint that is compelling, because the first thing that people do is, of course, investors. A lot of investors, they are invisible on social media. They're just spectators because they are looking, they're not participating. That's the thing that I found out. So you don't know who they are because they don't want to go above the radar, but they will be looking and they'll be checking you out. So I, as I said, all I do is I put my stuff on there, and then I find what happens is people contact me and they say, I've been watching you for a few months, and it's like, really, but you've never commented on any of my posts, or really, I don't even know who you are. And then they just say, yeah, I like it, and can you do this? Sometimes it's not always investors, obviously. Sometimes they're people that they want to be my mentee or whatever. But it is very, very important to pay attention to, as I said, your digital footprint, and never ever assume that it is not worthwhile.
Yeah, likes don't put food on the table. Likes and comments don't food up. But just touching on that point there that you said, and it's something I've experienced it because I network hard. I think I'm at every networking meeting that's possible in Glasgow and Scotland throughout. But what you'll find is if you're going looking for money, there's a good chance everybody else in that room is doing exactly the same as you, which is looking for money. Investors don't go to networking meetings to find people to invest in. They just don't. But that's what all these courses teach people. Go to networking meetings, exchange cards and coffees, and what you'll find is if you're at a meeting, there's a good chance what you're looking for, the person that you're talking to, they're probably looking for exactly the same thing. So that's why you got to get smarter. That's why you got to be, like, as you say, with the messaging, attract the right people, but also look in the right places. And that's something we kind of, take you through on the 90-day accelerator as well.
Definitely. I mean, the property meetings are, I would say, there are investors there. I think particularly down in the southeast. I mean, I've found investors actually at property networking meetings, and they tend to be very, very wealthy as well. Down in the southeast. So, for example, I found people. I found one investor who invested in a development project that I'm still involved in, and he had some significant funds. And I found a developer who was also looking to really retire from active development. But, so what tends to happen is if you're going to the right type of property meetings, and they tend to be the more high level ones down in London or in, the high value areas just outside, then you will meet people who are professional, sophisticated, people with experience of development, for example, or people who are serial traders, they've really built up some wealth. So you do get some people like that. But of course, that is not really an opportunity that is there at the moment, because we have to take everything online, don't we, right now?
Yeah, but also at the same time, for me, it's opened a window of opportunity. It's one of those ones. It's like now you've got nothing stopping you from connecting with someone the other side of the world, and that's part of what that sort of, for me, is a key. Is that you'll be in different points of the relationship with your investors. Some are just looking at you, some that you're in conversation, some that that you're ready to convert. But the key is to keep on sowing the field, keep on planting the seeds, so that when you need or that deal comes up, that you have people ready to kind of go to. And it's not like a cynical view, it's just investors need to invest their money. So it's incumbent on you to go and help them make money, and you make money as well.
Indeed. So we've got a comment that's come through. The investor should be aware of the risks. Buying the right asset at the right price should make the deal make money for all, the developer and the investor, for a win-win situation. So that's just what we've been saying. And the other thing is, because I tend to work for the investors, I'm an investor-facing person, so I sit on their side of the fence most of the time.
Okay, Jane, let me ask you a question. Yeah. So I, as someone looking for investment, you as someone that's, on the behalf of people that got money to invest.
And I've been an investor myself,
Exactly.
So.
So what are some top tips? Come on, we have to give the viewers some value. So 3 top tips.
3 top tips.
Yeah.
Other than
I'll give 3 top tips from my side.
Yeah. Okay. So the first thing is invest in yourself, because it shows people are different. People that invest in themselves behave differently. And the compound effect of investing in yourself is huge. It's huge. And I can always spot when somebody has invested in themselves because they are a more interesting person, they're a more knowledgeable person, their mindset's better, they're more positive and courageous. And so I would be looking for integrity, character, and those signs that somebody is committed to their own development. I think that's the number one thing, because as I said, investors on the whole, the kind of investors that we're talking about, they will have often made money themselves through business, some form of a business, whether it is in property, because as I said, a lot of property investors, because they know about, or developers, or as I said, prolific traders, because they understand that field, they're very open to actually collaborating or investing in other people's deals because they understand it, but they just don't want to do the work anymore. So they're smart, savvy people who have had that discipline of investing in themselves over many, many years. And so they've got that self-discipline, they've got that commitment to invest in themselves. So I would say that is a number one thing. The second thing is their business experience. And of course, I come from a corporate background, so do you. So I have decades of business experience. I feel very confident in that respect. And I feel as though I really do understand business. And so do you, but you've got a different take on it because obviously more financial. So I wouldn't trust my funds to somebody that I didn't feel really understood business. I just wouldn't, So if you don't understand business, then, I would, again, you can self-educate these days, go and do some serious online, education and actually understand, learn how to evaluate risk and how to understand business and hang around with people who could help you. So I guess that's number 2. And number 3 is just just be a really, I know what it is. Don't offer to investors. Wait for the investors to tell you what they want. Don't, and I see this all the time on social media. It's like, I offered an investor, I saw one last night, I offered an investor, 10%, and they laughed in my face. What was that all about? And then this other person, cropped up and said, honestly, investors are so greedy these days. They just want everything, don't they? And this is just, I had to kind of pipe up and say, look, really, you cannot make these gross generalizations. And I wouldn't normally say anything.
Why I'm laughing, because you're on so in this sort of scenario, you're on being the investor as such, because you are an investor yourself. Because it's funny, because as someone looking for investment, those 3 points are actually the points that I had in mind. So your first one, right, is about, you want someone to invest in themselves. So my point is, if you won't invest in yourself, why would you expect an investor to invest in you? So that's the whole point of making sure that you understand, and then that follows on to the business risk element, that you need to understand the field that you're in, because there's so many people that it's their first deal. Like I hear a lot about people be saying, "Oh, I've not done any deals, so I don't have any credibility." Well, your credibility can still be built up whether you've done a deal or not. So that shouldn't be sort of inhibitor to you raising investment. I think that's like a big fear amongst people that everybody started from nothing at some point. You know, obviously there's some people with generational wealth and whatnot, but you've got to start from somewhere. Now, it may well be the way to start there is to scale down a little bit, to build that credibility, build that trust, build that knowledge of understanding, because it doesn't take long if you immerse yourself, you invest in yourself to build that understanding so that of the deal that you're then going to offer, because you should be able to go to someone without a piece of paper, without any notes, and that investor should be just having a coffee with you and then pick away those questions. And the key point you said to me, which is brilliant there, was don't make an offer, because what you're doing then, and this is, you know, another thing that we kind of focus on, is you are telling them what you're prepared to give. That's not the conversation here.
No, that's not what investors want to hear. Do not tell them. Do not dictate terms to them.
Exactly. Yeah. Because what they will do is, and the thing is, there have been times when I've had conversations with certain investors where, in my head, because obviously you have to place them, engage them, and that's a skill and an art in itself, is they actually want less sometimes than what you're prepared to offer. But, you know, that's the other benefit. But the main thing is, you cannot see the investor as a piggy bank, because if all you see them as a piggy bank, is that's just not going to happen or work.
Yeah, exactly. Because, you know, the other thing is that investors want to enjoy their lives, right? So, I mean, investors, they've worked hard, they've made a bit of money, and all this goes across the board for all investors, whether they're a tech investor, an angel investor, even like a, you know, like a VC guy, anybody like that. Or the VC guys that I know, they're in it for the fun as well. You know, they've made money. They want to work with all these kind of energetic startups that, you know, get the buzz of it, you know.
Yeah.
So they are going to be very selective about the people, because they want quality of life, and quality of life comes from the relationships. They want to pick up the phone and say, you know, how are you doing, and feel really good about those investments that they've made, because they enjoy themselves when they're speaking to those people. It's important.
100%. It's that thing where, now a lot of people think the relationship is investor invests in the person and they get on with it, and then at the end they give them the money. No, the investor invests in you, and then you invest back in the person that's investing. It's not you take the money and go, and it's hard to explain tonight the sort of psychological shift that makes in securing and getting your investor on board, is getting that key sort of understanding of that you're investing in the investor, which sounds counterintuitive to what people might think. And that's the whole point of getting the ideal investor, because you are investing in their growth, you are investing in their returns as well.
Indeed you are, you know, and that is a good point, because investment isn't always financial. Investment, you're investing your time effectively. If you're you know, well, whether you're borrowing money or whether you're JVing or whatever the structure is, which again is usually should come from the investor rather than from you, because they will say, this is what I'm looking for. Then, you know, your investment is time, and actually time is the most precious asset of all. So never, ever, ever be or feel as though you are less than. And this is the other thing that I think a lot of you know, people can feel a bit kind of intimidated, or they can feel on the back foot or whatever, because they think, well, they're the ones with the money and I haven't got anything, and all the rest of it. And, you know, it really is just, at the end of the day, it's a partnership. It's a business partnership. That's what, you know, working with investors is all about.
You're looking for assured confidence.
Yeah.
You're not looking for ego. You're looking at someone that's done the research. They can back themselves, but they understand what they're taking themselves into, and also what they're taking you into as an investor.
Definitely. Well, Arshad, I think we've really done a bit of a deep dive, haven't we, with a couple of full starts as well on the tech for a Thursday evening. So I'm sure that you've got a full night ahead, I take it, of kind of feeding. Yeah, so
I'm investing in him, so hopefully he'll be my.
yeah.
At the moment, the returns are only smiles, but I think I'm winning in that sort of partnership at the moment.
Well, if he's 4 weeks old and you're already getting a smile, I'd say you know that's great.
Yeah.
You're going great guns.
I'll send you some pictures later.
All right then. Okay. Well, great to speak to you anyway. Thank you very much, everybody, for joining us. It's been quite a long session, and I do apologise for the slight technical problems that we had at the beginning, but I do hope you found it worthwhile. We don't usually talk about investment. This is Connection Central Strand is usually more about marketing and communications, but the topics that we've talked about tonight in the context of investment is really covers all of that as well. It's just all about people at the end of the day, isn't it? And so anyway, thank you very much for joining us, Arshad, and see you again soon.
See you soon. Take care. Bye.
Bye.